All right, welcome back to Lunch of the Market. Thanks for joining us today. Today we're taking a look at Motricity, ticker symbol MOTR, which is getting its head absolutely lopped off in today's session, about down 25%. Rarely are moves like this that are massively exaggerated and take place all in one day, especially because most of the move is just on a straight gap down from yesterday's close to today's open. It looks like Motricity lowered revenue guidance for this quarter, but actually expects full year revenue to be up year over year from last year. So I think it was a case of analysts had expectations that were too high, they didn't absolutely blow up the numbers, and they pulled an F5, right? But we know what happened to F5. The stock gapped down about $35 a share, only to recover most of that in the coming weeks. So we're going to take advantage of that and do two things. We want to get some long exposure to Motricity, and we want to sell some put spreads. I know, big surprise on the put spreads, but that's how we like to play it. Right now we like selling the 17.5, 15 March put spreads. It's only a $2.50 wide spread, but you're getting paid $1.20 to sell that spread right now. Even if Motricity really does nothing, all you need is for the stock to go back up to 17.50. It's trading at about 16.89 the last time I checked. It's about 16.70. So if the stock goes up 80 cents, these things are worthless, and you got paid $1.20 to do it. If the stock stays right here, the spreads are only worth 80 cents, and you still took in $1.20 to do it. So you're going to be profitable either way if the stock does absolutely nothing, or if it trades back up. But again, the stock's down $5.30 today. That's a 24% haircut from yesterday's closing price. It is highly unlikely that there won't be, at a minimum, people bottom fishing in the stock and trying to find a bottom in it. What does Motricity do? Because that's really behind why you should even own the stock, right? If any old stock is down 25%, it might not be an opportunity to buy, but this company does mobile data solutions that enable wireless carriers to deliver mobile data services to the subscribers in the United States, United Kingdom, Netherlands, and Singapore. Now, that sounds kind of ho-hum, right? But it's in the mobile internet tsunami, and what they really do is their MOTR service, which is a platform that provides tools for mobile subscribers to locate and access personally relevant content, location-based answers to their searches, right? Their MOTR platform provides mobile subscribers with access to 30 million pieces of third-party content or applications that the company optimizes and delivers to approximately 2,000 different models of mobile phones. Everything from your introductory flip phone all the way to smartphones. And that MOTR product is really what you're buying when you're looking at Motricity. One of the analysts, after the call, downgraded his full year EPS target from 80 cents a share to 59 cents a share for this full year. Taking the stock's current price of around 16.70 and the EPS estimates of 59 cents that we got from that analyst, you're looking at about a 23 multiple, which, again, if you're looking at a Netflix or an Amazon or an Akamai or a VMware, certainly you can get a lot higher than that in terms of the PE ratio is concerned. So I think it's overdone. Want to get some long exposure, and we want to sell put spreads. There's really no premium whatsoever in the February put spreads. In the February puts, you're looking at the 15 strike puts for February are trading at 10 cents, somewhere between 10 to 20 cents. The market is outright telling you that it thinks that the decline in terms of what's going to happen to the stock for the rest of the month is over, right? The move is done, it's put in, and it doesn't. The market is telling you that it doesn't look like it's going to go any lower. If you take a look at March, the 15s are only trading between 60 and 70 cents, and the 12.5s are between 5 and 20 cents. So again, if you look out into March, the options market is saying, look, I don't think the stock goes much below 17.50, which is why we want to draw that as our line in the sand and be short those 17.50 puts and get long the 15s as a hedge. If you really want to go for the gusto, you could probably get paid about $1.70 to sell the 17.5, 12.5 put spreads that expire in March. So take a look at that. You could get outright long stock, but what we like as a better alternative to that is to go look at the July contracts and consider doing a risk reversal. That's a long call and a short put. You can actually put on a 17.5, 15 risk reversal in Motricity for about 80 or 90 cents. Okay, so that means if for some reason the stock goes below 15, you run the risk of getting put the stock. But again, down 15, you're talking about a stock that was 30 and would now be 15, a 50% haircut. 50% is a Fibonacci retracement level. You should be safe getting long there. Then on the upside, you're long at 17.5, and you have no upside cap. So if the stock goes back to $30 a share in the next 157 days, then you have 100% of the upside completely captured by this risk reversal. So I like it. The structure, I guess it looks like this. You're long a 17.5 call, short a 15 put against it. Your risk doesn't start until the downside, and then you have unlimited upside above 17.5. You have 157 days for the trade to work out. So take a look at MOTR. That's our pick for the day that we're watching. We've done both. We're long those risk reversals, and we are short those put spreads for March. The risk reversals are for July expiration. The put spreads that we're short are for March. And the options market's telling you that in either February or March that the market really doesn't believe that it goes materially below the 17.5 level. And the only reason that the 17.5 level has so much premium in it is because the stock's already below it. So it's a little bit of a risky move. The March expiration is going to give you 38 days until expiration, so you have then to be right. If you're not, of course, your exit plan is to roll them down and out further on the calendar, and then you'll be short the 15, 12.5s, and you're going to just keep rolling this basically until you're right. So that's how we roll at Magnum Opus Financial. I hope that's helpful. Remember, massive, giant moves like this, 25%, when the story really doesn't change and it's just an earnings situation, or really in this case, it's a situation in which analysts they wanted more. They wanted revenue guided up, they wanted EPS guided up, and they got really conservative guidance from the company, and so the stock got absolutely hammered. But in every case that we've seen this earnings season, take a look at Amazon as another name that got whacked on earnings only to trade back up. So we're going to take advantage of it. We're going to get long some risk reversals in Motricity, short some put spreads. Thanks for joining us today on Lunch of the Market. Hopefully James Altucher will be next up on the list of our guests for America's Favorite Traders. We've got dinner with him tomorrow night at the World Money Show in Orlando, Florida. And of course, we're going to try to get him on the show to talk about his new book, Investing After the Apocalypse. All right, thanks for joining us again today. Have a great day, and we will see you tomorrow from the World Money Show in Orlando, Florida.